Propenomix Live supplement. This one I released on the 15th of December and called it Mortgages and Rents. Now, if you've listened before, you'll know that I like to start with a quote. And this week's is, "Service to others is the rent you pay for your room here on earth." And that's from Muhammad Ali, the boxing legend. So before I get started in earnest, I just want to urge you to get your tickets bought for the next property business workshop. It's the best Christmas present you'll get for yourself, I promise you. Thursday the 16th of January. Rod and I this time around are going to be covering productivity, planning for the year, but also financial accounting and bookkeeping. Why? Well, because we constantly see property businesses struggling with appropriate financial reporting, accounting and bookkeeping, and see the same mistakes coming up time and time again. This is to help get a complete handle on the financial performance of your company or group when you aren't at a level yet where you can afford a CFO or financial controller. The clue's there that you are therefore the CFO or financial controller, so set it up correctly once and then you can just iterate from there. All our workshops are always action-packed, content-filled, and they will stand alone in helping you to advance your understanding as a property business owner. And the early bird tickets with a 10% plus discount are live at bit.ly/PBWFIVE. So, welcome to the supplement. A next instalment of the English Housing Survey is going to have to wait for the deep dive because we've got the FCA's quarterly mortgage data, which is always absolutely key to analyse, and also a rental market report from Zoopla with some fairly contrary pieces in it, which also needs to be in the deep dive. Are your data chops slavering already? Mine were. So as the auction traders reported a miserable December thus far, one smug Silhillian sat in his ivory tower. Well, not really, it's a converted 3-bed semi, my office, ultimately. But I was watching the auction results roll in. Plenty of work to do after the auctions, and the portfolio inches forward at a very reasonable set of prices. If you're going to be in the market next year, get in the market this year and save yourselves a few quid, for goodness sakes. I've left the new NPPF framework, the big news of the week, to all of the experts, of which I'm certainly not one when it comes to planning. It is exciting, but ultimately only a step in the right direction, not a one-stop solution. So I've also refrained from getting too excited about it. I'm sure there'll be some fantastic stuff written at Planning Geek by Ian Walmsley, apart from anything else, but I'd also recommend you take a look at what Richard Little has been sharing on LinkedIn. Very knowledgeable gentleman. So, on to our weekly staples anyway. Chris Watkin, the stats guru of property, asked himself that question one more time. What is currently happening in the UK property market? Listings calmed down further, 21,200 last week, which again is to be expected as we get into this time of year as in December. Still, it's the second highest print for this week of the year in the past 8 years, only surpassed by 2018. We moved to 1.67 million listings for the year, and will clearly top 1.7 with 3 reporting weeks still to go, even if one of those is really quite slow. Price reductions, measured by percentage, actually calmed down a little after the budget, 11.1% reduced in November compared to the long-term average of 10.6%, but we were at 13% for October and 14% for September. So some leave the market instead of reducing at this time of year, giving up the ghost for Christmas. Also, some aren't aware that there's a 14-week rule on Rightmove, so you need to stay off there if you're going to go back on at the same price anyway, to go on as a new listing and to be counted in the stats as a new listing. And of course, some houses do that. So this is the problem when you aggregate all the data, you see these things can pollute it, but there we go, we've got to work with what we're given. So sold subject to contracts, 20,700, so nearly as many as were listed, far higher than 2023. That's 24% higher for the same week last year. And we're even further ahead of the pre-COVID averages than we have been, 8.9% above the 17 to 19 year to date now, nearly 9% ahead. And the fall throughs, they stayed well under control. So I think that the budget can be put to bed on that front now. The fall through rate was 40% for 2 months after the Truss quartering mess of 2022. And the 7-year average is 24.2. Last week printed 26.3. The market's accepted the changes and is keeping calm and carrying on. At this time, hovering around that long-term average mark. Net sales still look healthy, 15,200 this week. A solid print on the year, 52% above the same week in 2022. Now, and 17.5% higher than the same week in 2023. But what should be clear is that the relative market health is still very good. The stamp bumps are being more widely talked about every week in the wider media, and we will watch out for the effects of the reintroduction of the 2% band from 125 to 250 and the 5% band from 300 to 425 for the first time buyers. My view remains the same. Don't get involved in the scrum, stick to your guns, negotiate hard after April the 1st. Counterintuitive? Of course it is. But if you do the same as everybody else, just expect the same results. At least double the discount you're asking for on the basis of the extra transaction cost. So if it's costing 1% more, take 2% off. Trust me, I've done this before. Then a tip about sales. If you're listing anything and you're going on Boxing Day, well, make sure the office is open and taking inquiries that day. Otherwise, just list in the first week of January, once the kids are back at school. There was a very good point made on the Stats Show with Chris Watkin this week by his guest Steph Walker, who made the point that the quality of everybody who's looking at everything on Boxing Day might not be exactly what you want. It might be much more likely to be tyre kickers, dreamers, those with a hangover, etc., etc. It's difficult to know how true that is, of course, but there's arguments for and against. So, on the investment side, as I've said already in the intro, I'm still seeing and hearing more tumbleweed for the vendors right up until Christmas time. Traders are doing well with purchases and poorly with sales. Stay keen, keep your eyes open. There's bargains out there and a ton of lotted stock that isn't even being viewed, let alone offered on, that gets pulled. If it didn't get offered at auction, it doesn't mean you can't offer. This window of opportunity won't last long, but press your advantages if you are buying. Auction primarily is where I'm seeing that, but that's because it's a big focus of our operation. The open market won't be much different, I wouldn't think. Most traded stock starts its life on the open market, remember. Plenty are pulling stock because the market is so limp and expectations are not being managed. They're overvalued. They then won't take the interminable multiple chips to get down to a saleable price. Okay, that's the real time done. It's time for the macro. We lead with growth, or more likely lack thereof. The gear stick slipped into reverse for October, didn't it? Then we've got consumer confidence. One key of the way out of the situation we're getting ourselves into is spending, and that doesn't pick up without confidence. We also have the RICS house price balance this week, the residential market survey, the piece that often sees the surveyors trying to convince everyone they've got their collective fingers on the pulse. But often either the news breaks months and months late or misses the mark sometimes. But still, these are the folks valuing our stock, so we do need to see and hear what they think. And then once more, of course, we venture into the gilts and swaps for the latest. So growth, you remember it. At Spin Doctor School, they teach you to make every slogan a 3-worder just to insult the intelligence of the average member of the population. But I hear them say it works. It's suboptimal though, isn't it? When you pick the same word 3 times, emphasise it, make it the one thing, and then not only knock the train off its tracks, but send it into reverse. Since the election, we've hit the buffers and bounced back. The economic performance is woeful, and 100% of the blame lays at the feet of the Labour Party. Growth. There's more growth on my 11-year-old's upper lip. GDP was down 0.1% in October 2024, following a 0.1% drop in September 2024. In the first 6 months of the year, the economy had moved forward by around 1.25% or so. This is an utter tragedy playing out in real time. We're now only 1.2% ahead of February 2022 as it goes. We're 1.3% ahead of October 2023, which does tell you how good things were between Feb 22 and October 23, of course, which has nothing to do with the Labour Party. Services did nothing in October and are only 0.1% ahead of 3 months ago, which is always a killer blow. Production is what did the damage though, down 0.6% in October 24, having already shed 0.5% in September. So in terms of construction, repair and maintenance was down 1.3% in October 24, as it seems that sweating of assets becomes more and more popular or necessary. I'm sure that's bound to go up in November with the storms that we had, but there we go. When people are selling, they don't tend to spend a lot on repairs and maintenance. Construction dropped overall in October by 0.4, but was still 0.4% ahead on the rolling 3 month. So this has all underperformed the PMIs, but only by about 0.1%, which is basically a rounding error. So that's 2 months of spin on the minus 0.1, and if November prints the same, the R word will really start flying around. And it's at least 50% a confidence thing, if not a self-fulfilling prophecy. What a pig's ear. Still, how confident are the consumers? Overall, still negative, and considerably so, but things did pick up by an infinitesimal amount. The print was minus 17 compared to minus 18 last month, which is also 2024's average. Personal finances over the coming 12 months are being viewed positively, though. There's still a ton of uncertainty over the coming 12 months economically, though. I'd imagine because, as yet, no one other than the true believers are really sure if Labour are safe custodians of this economy at this time. The next 12 months prints a minus 26 compared to a minus 25 12 months ago. So that's the consumers looking forward and saying how good or not they think the economic performance is going to be. However, intentions to save are down. Well, that's a good sign for consumption, really. And major purchase intentions are up compared to 12 months ago. Overall, this looks a lot better than business confidence does, because that's cratered, but it's still stalling as the people do not as yet trust this Labour government to deliver, I'd suggest. Now, overall, the consumers are a pretty sensible bunch, and they look like they're feeling the next year will be okay, but nowhere near spectacular. I'm still feeling about 1% growth is a much better shout than the 2% the OBR have predicted and modelled. One more interesting tidbit from the survey is that Black Friday sales were up 1.8% in value. So they were down when you think about inflation, but they were 7.7% up in volume. So people spent a touch more money, but less than their pay rises in aggregate, on more cheap stuff. Okay, RICS, the Residential Market Survey, the headlines are buyer demand remaining positive, house price growth appearing to gain traction. Sales have levelled off, but new buyer inquiries saw a slight uptick in demand. House price indicators continued to move higher, and the near-term outlook for activity remains moderately positive in spite of recent rates increases. For mortgages, note. The big number that we watch from this survey as a sector is those reporting an increase in house prices at the aggregate level for November. The number was plus 25%, up from plus 16% in October. This is 4 moves forward in a row for the balance number, which was at minus 16% as recently as July, although at the time that number was utterly ridiculous. The breakdown is now seeing nearly all parts of the UK in the credit column when this figure is broken down into regions. Northern Ireland, the North, but also London are leading the way. So plus 47% see house prices moving up over the coming year. The lettings demand number printed minus 1%, which did make some headlines, even though this number is non-seasonally adjusted. It is the tiniest of margins and pretty meaningless. All it really means is tenant demand didn't climb even further in November. Landlord instructions remain at minus 13%, and expectations for rent still printed plus 29%, even though that's the lowest reading since January 2021, unbelievably. Maybe there are some chinks of hope for the tenant, we would suggest, moving just to a red-hot rental market from a white-hot one. I couldn't resist a group of graphs from the survey as the week's image, so you can check that out at my LinkedIn, Adam Lawrence, or you can also check it out on the Partners in Property blog on our website, www.partners-property.com. Graphs always tell a great story, and they speak volumes about the state of the market, and they break some stuff down into the regions, which I'll leave you to have a look at. Very interesting. That leads us to the gilts. A less eventful week generally, with a sting in the tail, as the traders seem to sniff out no chance of a rate cut at the next week's Bank of England meeting. It's a typical bond market, because you'd think the miss of the GDP forecast by a fair way, because the economic consensus was 0.1 growth for October, not 0.1% shrinkage. You'd think that would mean the bond yield would fall as speculation for larger rate cuts in face of a recession increase, but never second guess the bond market. Instead, there was a real fall in bond prices towards the end of Friday, and remember, as prices fall, yields rise. That's how bonds work. And so we closed the week at 4.244%, smack bang at the top of my suggested trading range at this time, which is between 3.75 and 4.25 for the 5-year gilt on the yield. We opened the week at 4.122, so it has to go down as a disappointing one. Thursday's close for the 5-year gilt was 4.187 compared to a swap close of 3.823. That's a monster discount of 36.4 basis points on the swap. And that keeps the correct 5-year mortgage rate for a limited company vanilla buy-to-let around 5.8 and investment grade yields at about 8.29. I'm still working on 6% cost of debt, 8.5% gross yield in the buy-to-lets I'm buying in order to have some margin of safety. But whatever happens, next week is the last serious trading week of the year, and anything that happens between Christmas and New Year shouldn't be taken to heart. Just don't put yourself in a position to let a crypto crash ruin your Christmas. These are the worst times of the year to subject yourself to massive volatility, unless you're as resilient as a rhinoceros. Okay, deep dive territory. 2 places to go here. Firstly, the FCA quarterly mortgage data. This gets published nearly a quarter in arrears, so this is covering quarter 3 of 2024. But there's some really interesting context in this one. Firstly, mortgages outstanding are at their highest level in nominal terms since quarter 1 of 2023. That's how limp the mortgage market has been since then. CPI inflation during that time has been 7.6% in total, so that's some erosion of the real value of that money as well. Gross advances were the highest since quarter 4 2022, where mortgages were advanced in spite of the damage the Trust Quarting budget had done to rates, up 8.9% quarter on quarter, up 6.7% year on year. Then new commitments, so this is the agreed lending in the coming months. It moved down 1.3 on the quarter, but is 34.2% higher than a year earlier, a massive improvement. Mortgages exceeding 90% loan to value increased by 60 basis points to 6.6%. That's their highest share since quarter 2 2008. So there's plenty of high first-time buyer leverage out there at the moment. But the pie of what the money was for broke back to 64.4% owner-occupier purchase, 22.8% remortgage, 7.9% for buy-to-let. Now that's down 110 basis points on the last quarter, but is 50 basis points up from the same quarter in 2023. But BTL finance remains very limp indeed, and this share under 8% is historically very low. The 10-year average is close to 13%, it's actually 12.8. The average over the past 6 quarters is 7.97, so the current figure is just under that 6-quarter rolling average, and it's been a very weak year and a half in the mortgage market. The percentages of mortgages up to and including 75% loan to value was the lowest it's been in the past few years, at 55.5%. 37.9 were in the category over 75 up to and including 90. Arrears then, the big trend to watch over the past couple of years, ticked down ever so slightly, snapping off the rise. Last quarter I suggested this trend had run out of steam, and this print confirms that's likely to be correct. Arrears balances are 1.31% of all loan balances. Now for context, this was 3.64% in quarter 1 2009, so that's where we are. Or aren't. We're nearly at just a third of where we were quarter 109. So it's not nothing, but it's only just off the launch pad, realistically. And then new possession cases were up 4.6% on the previous quarter and 45.5% up on a year earlier. So there has been more action taken on new repossession business. There are 6,976 repos out there. There were at the end of quarter 3 24 anyway. That's up 42.4% on a year earlier. So if you've noticed a few more in your area, you aren't wrong. It's still a very low number, again compared to quarter 1 2009 for context. The number then was 29,146, 4.18 times higher. Possession and arrears management takes time. The data is confirming what I thought I'd been seeing. I thought the buy-to-let number might be a bit better actually in terms of being nearer to 10%, but instead it stayed back close to the 8% mark. I just can't imagine our buy-to-let supply can be considered to be increasing this year, even though some commentators are still maintaining the sector isn't shrinking. Anyway, the second half of the deep dive is the Zoopla rental market report. Their stat around rental market rises, £3,240 in the average rental in 3 years. That's the average new rental, to be clear. That made the headlines this week, but the headlines say 3.9% higher in rents over the past 12 months, and they highlight that as the lowest in 3 years. Please always bear in mind that when Zoopla release a report like this, what they're talking about is rental inflation on new units, not existing units. So to an extent, this is what new tenants see and experience rather than existing tenants or existing portfolio landlords. And to an extent, this lessens the effectiveness of such a report. However, it is a valid in the now yardstick. In the real world, we see the Zoopla reports play out over the coming months and years, and this is why I like the ONS data. It much more mimics the experience of the portfolio landlord. Existing rents do not move at the pace of market rents, particularly in a time of fairly significant rental increases. Even the most commercial landlords do not tend to raise rents to full market rents ASAP. Those times are reserved for some point in the future. The rental inflation they see at 3.9% breaks back to 10.5% in Northern Ireland and 1.3% in London at the other end of the spectrum. It does seem to indicate London's found its current ceiling, and if there's any market that will be constrained by affordability, London is that market. They also importantly see a narrowing of supply and demand imbalance and highlight affordability as the one governor on rents, which makes perfect sense. You can only be as expensive as the very best candidate, of all the many candidates that apply for your tenancy can afford, and even then it won't always be an exact science. Zoopla prefer to frame it as affordability will be a growing constraint on rental inflation in areas with the highest rents, which suggests that this is the blocker in areas with the very highest rental income as a stat, rather than being an issue in the collar rent part of the market. So I would describe that as HMO rooms, one-bedroom flats, the cheapest rents on the market. Those rents have truly rocketed over the past 5 years because those tenants are often exposed to either the minimum wage or pegged to a wage that is reflective of all these moves upward in the minimum wage over recent years. Zoopla have also produced another stat which identifies the average UK rent is up £3,240 since 2021. So that's 27% up compared to earnings growth of 19%. My frustration here is always the cherry picking of the start position. As per the supplement of 3 weeks ago, if we start in 2015, and that's where the ONS starts as their reference year, rather than cherry picking, incomes are up nearly 40% and rents are up 23.5%. Now remember, new rents have moved a lot faster than rents across all tenancies, which lag quite significantly. This is much more likely to be reflective of the average tenant, and so they've moved forward whilst admittedly paying more for day-to-day life, energy bills, council tax and the likes. Zoopla, most importantly in many ways, sees rents rising 4% in 2025, with larger cities and London lagging behind rents in more affordable areas. This is a forecast, of course, but epitomises exactly why I chose to build my portfolio in suburban areas outside of the M25, before we even start on yield. The official Zoopla stats show rental demand 29% lower than 12 months ago, but still 31% higher than 2019. Likewise, they show 12% more rental homes available than 12 months ago, which I do find surprising. But what Zoopla are saying here is that higher rents have brought more properties to market, which does make economic sense. However, the stock of homes to rent is still 18% below 2019, according to them. The only time we'll really know what's going on at the moment is when we get next year's English Housing Survey 2024-25, which we'll only receive late November, early December 2025. But anyway, Zoopla had new rents as up 9.1% 12 months ago. Now they've fairly quickly fallen to this 3.9% they quote for this year. But I would note they're still predicting a 4% rise over the next 12 months. The ONS figure I expect will be closer to about 6.5% or thereabouts for the next 12 months. And Zoopla wouldn't deny this because the ONS figure is mostly based on existing tenancies rather than new ones, and the private rental sector these days sees an average tenancy length of 4.8 years. And Zoopla, Richard Donald, the research director at Zoopla, has said to me in the past that ultimately the ONS data tends to lag the Zoopla data by about 3 years. It's anything between sort of 2 and 4 years. So it's a trend, and that would make sense because the new rents are only percolating through and filtering through for some people as new tenancies begin. Although a lot more landlords, of course, these days are raising rents intra-tenancy. So Zoopla's rental index, therefore, as a whole, has dramatically outperformed ONS earnings growth since 2021, although now it's very much hugging the earnings side of things, which has moved up around 4% or more as we speak. That's earnings including bonus. Ex-bonus has still moved up more, as COVID bonuses have still continued to skew the figures. That should drop out by next year. The two highest growth areas by percentage for rents according to Zoopla are Northern Ireland at 10.5% and the North East at 8.7% compared to 1.3% for London. They then split London into the cheaper areas, rents up 5.9% in Havering and 5.25% in Barking and Dagenham, and then the more expensive rents are up less than 1% in Kensington and Chelsea, Greenwich and Tower Hamlets, and cite inner London as particularly unaffordable or not moving forward on rents. The big five outside of London, in England, for rent rises are Rochdale, Blackburn, Birkenhead, Burnley and Newcastle. They prefer to label this catch-up rental growth as renters seek out areas with better value for money in and around major cities. The last 12 months, sees 0.0% rental growth in Nottingham. However, I can personally confirm there's been significant rental growth on new rents in satellite villages and towns that can reach Nottingham relatively quickly. We've got a considerable amount of stock near there. Interestingly, Zoopla cites the East Midlands as the only part of the UK with more homes to rent than in pre-pandemic times. The expectation is not for a major increase in rental supply. They highlight what they call a steady sell-off from private landlords and cite greater regulation and higher borrowing costs in spite of increased rents. Their opinion is that the peak of the sell-off is behind us, although they do not evidence that statement. However, they recognise that when market conditions dictate, landlords as a group will increase investment and expand rental supply. pointing out this is likely some way off and will require lower base rates and higher yields. Base rates are not really the defining factor here, of course, swap rates are, but there is a natural link between the two, so we can probably forgive Zoopla that error. Zoopla highlights the demand side drivers as unaffordability of property for first-time buyers, migration for work and study, and low growth in the size of the social rented sector. They cite the one-off pandemic factors as behind us, and of course net migration figures are down, but they're still at an incredibly high level compared to pre-pandemic, for example. And they cite tighter visa rules as reducing the pressures from the higher levels of migration that we saw in 2023. There has been a difference, but like the job vacancies, there is still more than before the pandemic. The numbers for 2025, according to Zoopla, are 4% for rents in terms of new rent increases and 2.5% for house prices. They see rents outpacing capital values growth over the next 3 years, which wouldn't surprise me, especially now wings have been clipped in terms of our growth manifesto pledge, which is turning to dust as I type this. They also cite stronger first-time buyer demand as a driver for weaker rental demand this year. And that does make direct sense, but the lower migration figures are, in my view, more likely to be more of a driver. There's a useful analogy that Zoopla use themselves for their rental index. They're tracking the temperature of the water flowing into the bath, whereas the ONS are tracking the temperature of the bath. If you're running a business with a property portfolio, then the temperature of the bath is clearly more important to you, but both are important because the temperature of the new water will inform what you're going to do going forward. Your P&L will be dictated by the current temperature, but your strategic planning will be dictated by the overall temperature of what's coming in. So, they make the valid point the ONS index lags new rent, as I said, by 2 to 4 years. So, Zoopla always do a great job in sharing the data to a level of detail and with a level of transparency that puts their competitors to shame, alongside meaningful and agenda-free commentary that escapes the vast majority of the property industry. I do enjoy going through their reports with a fine-tooth comb. So as we wind down for one more week, a reminder that tickets for the next Property Business Workshop are out. It's Thursday the 16th of Jan 2025. Can't believe it's 2025 nearly, with some fantastic subject matter, planning for the year, efficiencies, and also financial accounting and bookkeeping. This is not how to use Xero, but how to ensure reporting is set up correctly and how to monitor it on an effective ongoing monthly basis. Come along and also get your strategic planning sorted out, and your January kick up the backside comes as part of the package as well. Early bird tickets are available with a 10% face value discount on them. Once they're gone, they're gone. These events do sell out. Rod and I hope that we will see you there. You can buy one at http://bit.ly/PBWFIVE. And there's also a link in the show notes. Now look, we know there's only one way to deal with all of this ongoing noise and excitement. Keep calm, always read or listen to the supplement, and carry on. Thank you.